care.
This is the New York Fire Department Pension Fund Investment Meeting. Today is 3/21/12. It's 6 minutes. No, 4 minutes. No. According to this clock, it's about 8 minutes after 10.
Your watches.
We're in the New York City Comptroller's Office, 1 Center Street, room 1117D, New York, New York. Can we have roll call, trustees?
Roll call of trustees. Ms. Ranjit Nagaswamy.
Here.
Mr. Larry Schloss.
Here.
Miss Janice Emery.
Here.
Mr. Stephen Cassidy.
James Levin has Stephen Cassidy's proxy.
And Mr. James Levin.
Here.
Mr. Robert Straw.
We enter in the room any moment.
Mr. John Kelly.
Sean O'Connor has John Kelly Smith.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
We have 22 votes in a quorum. We can start the meeting.
Okay. Let's start with the quarterly report led by Martin for the quarter ended December 31, 2011.
So you remember the last quarter was a dreadful quarter with September. The news is the December quarter is much better. We're risky assets through investor interest. And so you'll see for the quarter the Russell 3000 is much better as well as other risky assets. And brought the overall retirement system return for the fiscal year to date up to a lower negative number. And Larry will have the better news when we talk about January, February, and March to date. Turn to page 9 in the book, you'll see that the overall return for the quarter was 576 behind the benchmark. You'll notice that we have 2 lines there. One is the old policy benchmark in brown and purple, and we have the adjusted new policy benchmark in yellow, which is a target that we're aiming to get towards over time. The fiscal year to date that is showing here, is minus 476, but as I mentioned before, with very good returns in January and February that Larry will go through, have effectively brought that back up to a positive number. And obviously the 12-month and 3-year numbers are positive numbers, with the 3-year number being a very strong positive number but behind the benchmark and returning 12.24. The next few pages show, and there's actually 3 pages, the top part of the page shows where the money is, the pie chart, the asset allocation. That does not change from page to page. What does change is the first page on page 10 shows versus the old policy rates. The next page shows versus the new policy rates, and then the adjustment, meaning with the market places, the fact that we're not investing overall in hedge funds and opportunistic fixed income in some other areas. So as an example, in the old asset allocation, we were underweight U.S. equity, which is the green bar all the way on the left. In the new asset allocation, because we reduced U.S. equity, we're overweight. So we're in the process of moving that down. I also want to draw your attention to the pink bar on the bottom right, which is the underweight and opportunistic fixed income, and those are the deals that we've been bringing to you and hope to bring that underweight down pretty substantially over the next few months. Next, we're going to show attributions of returns. And the factors used are allocation factors and management factors. We also show the old policy and the new policy index. We're in the process with Bank to tweak these numbers to make sure that we have a more accurate representation of where we are versus just plain old marketplaces. And the bottom line is that these numbers will converge over time as the old numbers converge. But for the quarter ending the 576 return was underweight slightly from, actually it was underweight by versus the old policy index, but less versus the adjusted policy index, and the allocation effect was less for the old policy index, for the adjusted policy index as well. And we'll talk about the cash in a moment. I want to draw your attention to page 17, which is how high it did versus so far public funds. And all the way on the left of the page shows to the one quarter, the fire is 576, put it in the top quartile and 20th percentile. The other good news is that in the middle of the page, the 1 year, 3 year, 4 year, 5 year, over the last few years, the returns that we've seen have placed fire either in the top quartile or above medium or just below medium in the 1 year case where we're in the 57th percentile. So returns have gotten higher, at least versus your peers, over the last few years.
So, Doug, do you all at NEPC have a version of this page adjusted for our size and for the risk that we take? Because this is apples and oranges, right? Good or bad, it's a worthless comparison.
I don't think it's a worthless comparison. I view it as a secondary comparison to your policy index, and it just gives you a sense for what peers are doing. But you know, when we show this page in our book, the first thing we do before that is show you how you're different, your equity ratio, your fixed income ratio, and it's to reinforce that you are accepting of your policy and how you're different from peers if you care that you're, you know, what peers are doing.
And as we go forward, we're going to be, I know it was requested previously with this board, we're going to revise and more informative page on the asset allocation, as you described, it was a 4-page book at the time, which where you are versus your policy and what the policy you are, and we can start to do that for you.
But can I just go back to Doug for a moment? Thank you for that, Martin. Can't wait to see that page.
It's actually
2 pages. So, I see what you mean about this, but to the extent that it's about $2 billion and $150 billion funds, and we are a $9 or a $10 billion fund, I go back to there's limited useful information. So, is there a way you all can help us find the right peer group and show us that information on a quarterly basis?
Sure. This peer group is actually greater than $1 billion. And we typically, with a fund your size, would show that same peer group greater than $1 billion. But we can cut our universe to show greater than $5 million. Of course, the sample size will shrink over time. Our sample includes all of our public funds, which we have about 55, and then we pool our data with another 14 consulting firms on a blind basis, so that pool, that data set expands. And so we can show you how many samples. I don't think they have the sample size here, but we can get the sample numbers from BNY and show you a comparison point of our $1 billion and above and a $5 billion and above. And I'm pretty sure BNY can do $5 billion and above too.
Yeah, the Tufts, this is coming to Tufts, and the number of plans in this, we can definitely get maybe tier of this, so you see who is in the universe at that spot.
But
The size
for
and
ours,
risk, though, right?
yeah,
Great.
ours can show you the equity ratio and then risk return charts that relate.
Could you bring that to the next meeting?
Sure.
Great, thank you.
Let me just note for the record that Robert Straub is now in the meeting, present in the meeting. Thank you.
But Martin, if I may observe, I think these comparisons with other funds still show the fundamental issue that the only thing that really makes fire in the New York City funds that much different is they're more heavily weighted in U.S. domestic equity.
Correct. Over the last 3 years, the equity allocation has helped, and as you saw in 08,
Right, and so fire shows itself in the top quartile when domestic equity does well. It shows itself badly when it doesn't. Other than that, it doesn't really show too much, except that we're not meeting our policy benchmarks.
right. And as rationale for that, it's a combination of getting into the new diversifying asset classes, but we're also bound by the statutes in those books behind me as to what we can do and the maximum we can do in those alternative asset classes that we have.
But in theory, if we were in exactly what everybody else was in, we'd be at the 50th percentile all the time.
That's right.
If assuming we did as well.
That's right.
So I think that presenting this information is useful, but it has a story behind it in terms of what it's telling you that doesn't necessarily mean we've been good in a quarter. It just means we're different.
If we had underperformed in a strong equity market, it would tell more of the story.
Yes, that is definitely
That's true.
Well, but the fact that we've underperformed our policy benchmark
And-
tells you part of that story.
We've done that, yes.
Yes.
Well, but the policy, this is the new policy.
Right, and we're going to be tweaking that to reflect reality, to make sure that the policy benchmark reflects where we are at the time more closely, and we hope to get that as well in the next set of months.
So we shouldn't historically go and use the new policy benchmark historically. We should just time relate.
We don't.
Yeah.
What we're
It
doing
should
is,
be
what
the
we're doing is going
relevant
forward,
policy benchmark.
but we're going to go back the last few months as the new policy benchmark was established to make sure that the adjustment pieces have been marked as close as possible to the reality of where we were until we reach the policy.
So show the incremental points between point A and point B reflected monthly report.
Right. Yeah, it's the adjusted policy because that's got the parking places in it. Right. That's as good as we could. That's what we sort of all agreed to.
But I think, Bob, and your primary point is when you look at these comparisons, the primary sources of attribution versus your peers are what's your equity ratio, what's your bond ratio, and then the fallout of that is how much is in alternatives. And we can give you the data points on how you're similar and different. And you candidly, the other point he was trying to make is the past, you've risen and fallen with your equity ratio, but the new policy is designed to move you away from that positioning and spread out your risks better. You can argue that in some sense you're becoming more like your peers because you're moving towards a lower equity ratio. It'll be closer to the average equity ratio of the peer group, but we're only seeing that for a couple quarters on a 10 or 15-year number. So it's going to take time.
And to Bob's point about our underperforming our policy benchmark, on page 16, we can see the management effect. So over the longer term, we can see that we were underperforming in private equity and private real estate versus the benchmark. But this isn't actually showing us how our allocation decisions.
And this was
has
brought up in
affected
another board,
performance.
and
Yeah.
just this past week, we've been working on it with Bank of New York. The numbers, because of how attribution works, you have a factor and you can have a big residual. So we're working on making sure that we have a bulletproof page that makes sense, that we'll put in the book, and we hope that it gets.
I think your report is having trouble here.
That we
When
can-
you turn this way,
I'm sorry, that we expect to have that page as a complement to the management effect or the attribution effect. We're working on that with Bank of New York.
And there's one key point on page 16 is that when you use alternative assets, the benchmarking in terms of setting a benchmark as your opportunity set for passive management becomes less relevant. The private equity is the biggest source of the tracking error over the 3-year period, and that's because we've made the choice to use a public markets plus private equity benchmark, which in a 3-year period where the equity markets have done well, remember we just rolled out 2008 out of the 3-year number, so that's not there anymore. We've just got that first quarter of 09 that's still hurting the 3-year number for equities, and that's where almost all of the underperformance versus policy comes from, that negative 0.78 in the middle of the page. If we compared that, if we swapped in a peer group private equity benchmark, the numbers would improve.
And as a further point on that, private equity quarter has underperformed, but that's the typical lag, and that will wash out next quarter.
Well, hang on a second. We do have an alternative benchmark for private equity. We can use it here.
Larry,
Yeah.
the report is having
Sorry.
trouble here.
We do have an alternative private equity benchmark. We could use that here instead of the
Instead
Russell.
of Russell 3000.
Yeah. To your point.
Well, I would say that under 3 years, the peer group is the relevant benchmark, but over business cycles, this is what we're trying to achieve.
You're benchmarking where you took the money
So in
from.
the short term, risk premium-driven benchmark, equities plus 500 are not relevant. You don't expect to beat it every quarter.
Right.
The other issues I find when clients get frustrated with this effect and they switch, they tend to want to switch back, when it becomes a little bit messy. We can always put the peer group 3-year return
Well, not the median,
footnoted or
that's not our
something.
benchmark.
Right, it's top quartile. Meredith's going to give us definitely top quartile. No hesitation about it.
I don't think, in fact, to have that focus on these benchmarks. Martin, I don't think enhanced yield benchmark is triple Bs.
We're going to be talking about that next month
I just talked about right now.
in executive session.
Okay, but this is the wrong, no matter when you talk about this is an investment grade benchmark.
No, the double B, single B is...
Oh, I'm sorry, I thought it was triple B.
No, it's double B and single
Never
B.
mind. Just looks like three Bs to me.
I don't have my glasses, but I do.
Okay.
Okay, so Steve on with the equity column.
Okay, Mark. So if you turn to page 21, this shows a chart of your domestic equity return versus the Russell 3000 benchmark. In the quarter, in the fiscal year to date, the trailing 12 months, a bit behind the benchmark. As you look out 3 years, kind of roughly in line with the benchmark. The next page, 22, goes through some of the details. So I just pointed to 3 columns here. The index return, the actual return, and then the difference column. As you'll see in the index return column, some strong numbers here for the quarter in U.S. equities. Small cap being up about 15%, mid cap up about 13%, and then large cap up about 12%. So good double-digit returns for U.S. equities in the quarter. If you look, though, to the difference column, I'll just highlight a couple areas here. In small cap active, underperforming by about 200 basis points. Just in the quarter, that's Brown and Perimeter 2-year managers. Brown has had a tougher quarter, better for the 1-year number, though. If you go down a couple rows, it's mid-cap, small to mid-cap active, underperforming by about 400 basis points. These guys were hired a year ago. That's Security Global. And so nothing, I don't think, too alarming there yet. Page 29, flip to that. That's the international allocation. And again, I point you to these same 3 columns, the index return, the actual return, and the difference. And you'll notice in the index return column, the international markets just didn't do as well as the U.S. equity markets in the quarter. You can see EFA roughly around 3%, and emerging markets roughly around 4%. Again, that's compared to strong double digits in the U.S. If you go to the difference column, here there's a good story. This is a quarter where all the EFA styles, growth, value, and core, all outperforming nicely. And as well in emerging markets, your active managers there did quite well, outperforming by almost 200 basis points. If you turn to page 30, next page, talk about EFA. So fire is the purple bar and the yellow bar is the index, and so you can see in the quarter nicely outperforming the index there by almost 100 basis points. Similarly, still outperforming in the fiscal year to date, the trailing 12 months, and very nicely in the trailing 3 years by almost more than 200 basis points. If you turn to page 35, that's the emerging markets. And again, fire's the purple bar, and yellow is the index. And here as well, you got in the quarter outperformance in the fiscal year to date, trailing 12 months. While these are negative numbers, you might remember that 2011 was a difficult year for emerging market equities. But if you look out a little further to the trailing 3 years, you're up 21%, and you're outperforming the benchmark there by about 100 basis points. And now I'll turn it back to Mark.
So on page 38, we show total fixed income allocation as of December 31st. It was 33% of the fund, $2.5 billion, and the largest allocation is shown in green, and that's the investment grade 4+5 program. We break that program down on the following page by 3 subsectors. You'll note in the over-underweight column, we were underweight treasuries, overweight spread sector. All of these sectors had positive returns. The credit sector had the strongest positive return, and we attribute this to investors looking for more risk in their portfolios. The managers for the treasury and mortgage sector were slightly positive or slightly negative, and the credit sector managers were ahead by 34 basis points. We'll talk about January and February and how what's going on in the market there a little bit later. Returns for the program are on page 40, And while I can't compete this quarter with seamless equity returns, the quarter returns of 1.37 were positive and are slightly ahead of the benchmark. Fiscal year to date, returns of 5.55, slightly behind the benchmark, and that's mostly due to the underweight in treasuries, as well as the one-year number return very strong, 891, and three-year return of 895. For the 1 year, slightly behind, and for the 3 years, actually ahead by 135 basis points. Returns are in the 6 to 7% range longer term, and I point this out and have in the last few quarters that if you look at the bottom, we've achieved these returns with 3 to 4% overall standard deviation. The TIPS returns are on page 41. Again, positive returns, these are treasuries, and there's been strong demand on a technical basis for these securities, so the return was 273, just slightly ahead of the benchmark. Fiscal year also a positive number of 778, and the 1 year 1359. High yield, which had been very hot in 2009-2010, cooled off, actually had negative numbers in September, but with the investor interest again in equities with the resolution or seeming political resolution of what's going on in Europe. For Greece, investors took more risk, and you see the returns in the yearly 6%. That was behind the benchmark by 37 basis points. The fiscal year-to-date returns are now positive by 87 basis points. That's behind, and the 1 year return virtually matches the the 3-month return. That's also behind. The longer-term results are ahead of the benchmark, and the 3-year number, in fact, is over 19%. Sorry about that. I can't read that. And in fact, when you go out even 10 or 15 years, results are 7 to 8%. The volatility is about 2/3 to 1/2 of the volatility of the equity market. And we'll be talking more about this in the coming months due to the search that we have ongoing. Convertible bonds are shown on page 43, and for whether the results were positive, they are very sensitive to equity results because of the delta that's for the index that's about 0.5. The results were 396, which was behind the policy benchmark of 422, about 26 basis points, but it was ahead. Each manager was ahead of their benchmark by a nice amount. And we've been talking about how convertible bonds in the past, there is no perfect benchmark, and the benchmark itself is not how the managers run their money, but you need a reference point, and that's shown in yellow. And in fact, the fiscal year to date, which was minus 781, was ahead of the overall benchmark. And this is a pattern that we had talked about way back when we started the program, and as you've seen quarter by quarter, that when you have a negative result, we're ahead of the benchmark. When you have a positive result, we're ahead of the benchmark. Generally, it has to do with benchmark construction that the large issuers in the index run, and the managers don't own those securities. We have Kathy Martino here to talk about ETIs. I do want to point out opportunistic fixed income was not in this. We do have it in the appendix, but we are working on a specialized report that will be included in this that we'll have for you either next month or certainly by next quarter to show the IRRs and the benchmarks.
Good morning. The ETI portfolio is again showing net of fees, which average in the high 30s on an annual basis. Although it underperformed by 9 basis points.
Could you speak up a little bit?
Fiscal year to date, it did outperform its custom benchmark for most of the longer periods. On page 7 in this booklet, it shows your collateral benefits by investment. A couple of highlights: you did invest in 161 units of affordable housing in the fourth quarter. And the AFL-CIO Housing Investment Trust invested $12.5 million in a project in Harlem. Are there any questions?
Would you just repeat the last statement, the last sentence?
The AFL-CIO Housing Investment Trust invested $12.5 million in a project in Harlem.
Moving on to
the real estate portfolio for the third quarter, 2011. It starts on actually the large board book on page 16. 16. So, in alternatives, as you know, the reporting has a lag, and so we're reviewing the results of third quarter. We know that third quarter was pretty tough in terms of some external shocks, both domestically and globally, so we know what happened. I'm not going to really dwell on that, but the market value of what was in the ground for the fire portfolio was $192 million. We had about $111 million of commitments that are unfunded, and altogether our exposure to real estate on a market value on an unfunded basis is a little north of $300 million at $303 million. So real estate continues this slow but uneven recovery. We've talked about the fact that investor interest has been extremely keen for the core product in gateway cities. People are looking for stabilized assets, and as a result, pricing is a bit overheated in some markets for that. In terms of where yields can be found, they can be found in deals where you have to put in a little bit of elbow grease. So in instances where the capital stack is broken or the asset needs to be repositioned or the landlord just plain ran out of money, but you have the cash to be able to lease that building up. That's where some deals can be found. As it relates to our performance for the quarter, our performance for the quarter was flat. So let me kind of go over that with you, and that compares to our benchmark of 3.3% for the quarter. So in terms of the core investments that we have, they sat right on top of the benchmark. So the benchmark delivered 3.3%, and that's what our core managers did. Our non-core managers, however, were kind of impacted by all that went on in the third quarter, the volatility in the capital markets. These guys need healthy capital markets in order to exit their investments, and the whole premise behind mark-to-market is to assume what would someone pay me today. So our non-core managers were very conservative in their approaches to value. Ergo, they were at minus 3.3, whereas the core guys were 3.3, so it was a wash for the quarter. As you look out kind of in the 3 to 5 year range, again, the fact that our portfolio is predominantly non-core as opposed to core, the fact that we increased our allocation in 2007 from 3% to 5% and began to take larger bites of the funds that we were seeing, and pretty active right before the downturn. So our managers are kind of facing a headwind. That's kind of what you see in the unevenness in our performance. But I guess I would say that we are 2.7 invested at this particular point. This is a long-term play for us, real estate as an asset class. You've seen some of the deals that we've been bringing to you this year. We are being very careful and thoughtful in making sure that the new deals complement what we have in the ground. So I guess the bottom line is we have a 5% allocation and we're not done yet. So moving on to page 18, which just gives you a snapshot of the portfolio. Just here again quickly, we have a 5% allocation to real estate, which at that point would have equated to a program size of about $360 million. In terms of our IPS, it's desirous to have a portfolio mix of about 40 to 60% core, 40 to 60% non-core. I referenced the fact that we are predominantly non-core. That's at 56%. That would include your emerging managers as well. As of the third quarter, 44% of the portfolio was core managers. I mentioned we were 2.7 invested at this point. We're about 4.2 committed. We have about 11 core investments and 23 non-core investments. In terms of our recent activity, during the third quarter, we closed Carlisle 6 and Taconic, and some post-quarter activity. We committed and closed on the Divco West and Blackstone 7 deals. On page 19 is just a report card that we make for ourselves to kind of keep track of some important risk metrics. We talked a little bit earlier about the underperformance that we've seen in the portfolio. We're on target in terms of the portfolio mix, diversification. The leverage is just slightly above the 50% at 52.1%, but as I mentioned, we're only 2.7 invested at this point, and we are well within the bounds for manager exposure. The last page just shows you how the portfolio is diversified by property type and also by geography. So, any questions?
Okay, and with that, I'm going to go to private equity. I'll be brief. So again, just by way of reference for everyone, the target allocation for private equity, this is on page 25 of the big book, is 7%. New York City Fire pension fund today is slightly below that, about 6.5%. For the quarter, there were 4 new managers added to the portfolio, 5 new investments. From a return standpoint, as of September 30th, IRR was 10%, down from 11.2%. If we look at the multiple today is roughly 1.3. Again, everyone's talked about what a challenging quarter it was. Just as a snapshot looking forward, we've received some of the Q4 numbers, and right now everything is kind of moving in the right direction. If you look on page 26, it just shows the overall quarter versus the benchmarks. Again, 10% for the fire portfolio, exceeded the Russell 3000 plus 500 by 150 basis points. Forget about the median return. It slightly underperformed the upper quartile, 10% versus 10.8. From a policy standpoint, just by way of reference, in the middle of the page, on the buyout side, targeted allocation 60 to 80%. Today, buyout is at 66. Venture capital, again, we've gone from venture, migrated into growth. Targeted allocation 10%. We're slightly above that, 11.7. The balance, again, we've broken out between distressed, mezzanine, and secondary. That we're in line with what our targeted buckets are. In the upcoming quarter, we are going to take the fund-to-funds programs now that are fully committed on the EM side, and we're going to take all those individual funds and just respread them between buyout and venture since we know what they are. People get a better picture. The other bucket will decrease. The buyout bucket will increase. If we go forward a little to page 34, this just goes through a couple of the names. Those 5 names, so Axis Secondary Fund 5, BC9, EQT6, Pegasus 5, and Comvest. 3 of those are new names. Pegasus and Comvest were both re-ups. What I would touch briefly on page 35, this is really the changes in valuation for the quarter. The 2 I would note are number 2 and number 6. One is Axis Secondary Fund 5. The second is Lexington Fund 6. Those are the positive increases. Those are both from secondary funds. Again, we'll see this going forward. The secondary funds have clearly been accretive to the overall portfolio. Last thing I would mention is on page 38, which is the benchmarking. We can look at the 1, 3, and the 5-year, but again, private equity is an illiquid asset class, so the best way to look at this is on the 10-year and really since inception. And what you'll note here is that the overall private equity portfolio has beat the Russell 3000 plus 500 on both the 10-year and since inception, and continues to move forward towards an upper quartile benchmark. And with that, if there are any questions, that's private equity for the quarter.
Okay, thank you. That ends the quarterly report for...
Larry, can I ask a question about the quarterly report?
Yeah.
So Kathy had said that the ETIs were net of fees, so does that mean that all the rest of the returns in that book are gross of fees? The quarterly book that we just went through?
These are gross. There's an appendix in the back that's net.
Is there any way that you can get these numbers net of
2 years into it, I can't get them net.
Really?
Yeah. No one's more pissed off about that than me.
Because you were not seeing
Because the bank in New York can't figure out how to do it.
But the numbers in these books are net of fees. Are these gross of fees? These are gross of fees
Those are
too?
gross of fees too. They're working on it.
Doug, does
Despite-
NPC have the ability to do net of fee calculations? I just asked Doug if NPC...
We do the net of fee
Sorry.
calculations, but we have the same trouble that BNY has, is how the fees are paid. So you can do it a couple different ways. You have to figure out the best methodology depending on different client accounts. Some finding out to use community funds, it's very easy to do it there. When you have a mix of community funds, separate accounts, some of which the fees are paid directly by the custodian, others are, billed. You've got lots of different issues.
Performance fees.
And then you have performance fees, which, do you accrue them, that type of thing. There's a lot of moving parts, unfortunately.
It's unacceptable that they're gross.
Yeah.
And we've been working with the custodian to get them to be net. And it's 2 years later, and they're working on it. Sort of. I mean, they've had bad meetings over it. But guys, come on.
The other question I had with regard to fees is that since I've been on the board, I don't recall us seeing an annual fee benchmarking report to show that the fees that are being paid out of the fund for investment-related expenses are reasonable. Is that something that we do on a regular basis? Is that coming up at an upcoming meeting?
Martin, have you ever done that?
We had a study that was done a few years ago, but it's now goes back a number of years. But it's not on a regular basis.
So why are the fees of 2010 still estimates? I don't understand.
Because some of the performance fees still have to be clarified. Not all fees have been paid.
For 2010?
2010, that's what it says.
Not 2011.
Page
2010.
Page 64.
Oh, sorry, 2010. That probably needs to be updated.
Which page?
You're
Page
looking at the
64.
appendix in the back. No, I know what you're referring to.
I was just running a Larry.
I guess my point is that since we're not seeing net fee performance, which we all agree we really should be seeing, we should have some way to understand that the fees that we're paying otherwise are reasonable. So if there can be some benchmarking done with regard to fees.
We're working on some benchmarking work.
We have
fees included relative to peers.
Relative to peers? Is any
In size, yeah, we can do a peer. I'm doing one for the state of Vermont next week, so I can do it. We can do it. We use the investment data, and they have a sample that you can pull it, but the size drives it, right? So if you get $200 million accounts, that's going to drive the fee average for a broad product category much lower. And so we do it that way using a pull of peer group comparisons from investment, which is very broad. And then we also have a peer group comparison from data that is updated kind of every other year from that cooperative, our peer group that we use for public fund comparison. So
is that part of the service you signed up for?
Yeah. I'm signing myself up for more work, but absolutely, that's absolutely part of it. So it'd probably take us a month or so to get it put together.
That would be good.
The big thing I have to do is make sure we have all the correct fee schedules updated, especially because we have a bunch of new managers that have been hired in the last year.
The private equity and real estate numbers are net of fees.
Yeah.
Right.
So we just focus on the public markets. Yeah.
And we'll get the final fiscal year 2010 numbers for you next week.
So Doug, in that same homework vein, does NEPC update its return estimates every year? A bunch of our other consultants seem to do that.
Asset class returns, yes.
So I think it's a conversation we should have at least once a year at the board, and it's just where are the markets, where are your estimates, where are your risk numbers, correlations, what's happening.
Okay.
So is that something you can also...
Yeah, I would think it would be updating the work we did last year and just saying, here are our 2012 assumptions, here's what it means for the policy mixes that we looked at last year and approved.
Yeah, not to
The
redo
current
all that, but just to revisit all that.
Yep,
Yeah,
yep.
great.
Yeah, no, not redoing any of the mixes.
Still executed.
Okay. So let's go to the January report. Martin, you have anything we need extra?
We have extras here. I just put them around.
Okay. Go quickly. The bottom line on all the economic slides are a gradual recovery, moderate, I think the Fed would call it, uninspiring, others would call it. The key number is probably page 6. Not the key number, but the number to focus on is 6, which is weekly unemployment claims. And, it is trending down. You can see on page 7. The unemployment rate is trending down, but at 8.3% is still too damn high. And you can see on page 8 how it compares. It's the blue line, how we compare to prior recessions. And, again, it's in crawl mode. Too high, but at least it's slowly coming down. I won't bore you with the rest of these charts. They all kind of get you to the same thing, which is slowly up. I will get you, however, to page 22. 22 is the VIX, which is volatility. We call it the ECB. In Europe, came up with 3-year inexpensive loans for European banks in mid-December, and since then the markets have recovered smartly. There's been calm in the markets. The VIX has gone down. The risk on of the traders has meant that people got out of risk less securities like governments, so people have sold all their governments. If you look on page 23, you'll see, you might not see it on this chart actually. The 10. Yeah, this is the 10-year chart. The next page on 24, you can probably see. You can see this. It's sort of like the heart attack is over. We start to flatline. In the last couple of weeks, rates have moved up because, again, people are selling treasuries because they're saying, all right, it's safe to come out now, and then putting the money back in the stock market. The spreads are narrowing on page 25. You can see that as the high yield spread is coming in closer to the government rate. The stock markets are going up. You can see it easily on page 26. Again, it's the green line at the bottom. If you jump forward, I'll get you a nice chart on page 30. Again, you can see since the middle of December, all the markets have gone up: U.S., EFA, and emerging markets. That's had a very good impact on our fund. If you look on page 32, at the end of January, we're back to $7.9 billion, which is about where we ended the fiscal year. We're up a couple of percent through that, so we're through $8 billion again. We're probably pressing the high of $8.1 billion, depending on the day now. So I'd say we're probably through the high, but again, it bounces around in the markets. You can see on page 33, again, we're into $8 billion category right about now. If you jump to page 36. If you jump to page 36, thank you. This is the adjusted policy weightings that we're moving toward. At the end of January, we still had 4.8% cash. We're now down to about 1.5% cash. The difference has been about 0.5% in hedge funds, 1% in U.S. equities, 0.5% in emerging market equities, a little less than 1% in high yield, and about 0.5% in opportunistic fixed income. So we're doing what everyone else is doing, which is getting back to the markets.
Well, that's just the trading, the parking places, right? We just went back in. We're not attacking.
I'm sorry.
No, these are. When you put back the stock market, it's in the stock market.
But is it because of the parking places, or are we still trying to time these markets?
No, we're putting the cash back into the markets. We're not timing it. We're trying to get back into it. We're trying to go we went from risk off, high cash, right? To put
Expensive trade.
To put the money back into the markets.
But we're also funding new asset classes.
And we're funding the hedge funds and the opportunistic fixed income. So we're getting back into where we're supposed to be so that we can finish the asset reallocation over the next several months. And these are the new ranges with the parking places.
It says adjusted on them.
Yeah. 38, right?
36.
36. So this has the parking places because we'll always have parking places. So if you look on page 37, again, if you see how it lays out at the bottom of 37, and look at the adjusted policy target, the 62.7 for equities and 37.3, and you compare it to the actual, we're pushing the high on the equities and the sort of the low on fixed income. to net through everything.
I cannot read page 37. I can't wait for the new pages. I can't make any sense of this page.
It's
just
forthcoming.
overwhelming. Thank you. Please.
All right.
On the bottom of the page, Larry?
The bottom.
Bottom of the pages are the rules.
Look at page 38, you can see how the markets were in January. Again, the far left-hand column. So the U.S. markets were up 4, 5, 6%. International was up anywhere from 5 to 11%. And the fixed income markets were up a couple of percent as well. Skip to page 40. You'll see the month of January made 4%, which gets us to about break even for the fiscal year. If you go back to page 39, you'll see that next month, which is February, again, the U.S. markets are up about 4%, international is up 5% or so, fixed income is sort of flat. So again, February we should be up, I don't know if I had to guess, I'd say 1 or 2%, which makes it, which again gets us north of $8 billion. That gets us positive for the year. The rest of the individual managers, most of them did all right in January, but there's a lot of volatility in the fiscal year numbers because some did better than others in the downturn in the fall. Mark, you have anything particular you want to talk about managers in January?
Just that the high yield managers, we're going to be talking about that in the executive session next week.
Next one. Steve, anything? No. Okay. That's the January report. Had a nice January. Should have a good February. March, I presume, will be choppy, but we'll see how that sorts itself out. That ends the public session for the pension fund. And now, Mark, I'll hand it over to you for the...
We need a motion to move out of public session and start the firefighter variable supplement. Just a second.
Second.
Any objections? Hearing none, the motion carries. So we're now into the
So it comes up to $13 million. It's a good quarter. Fiscal year to date and 1 year numbers are negative, but in January, February, March to date, it significantly brings those numbers back up positive, but not quite there. The 3 year number is very strong at 19.01. And then for equity, the last slide we had is on REITs. Morgan Stanley is the manager here. About 5% of the portfolio is in REITs, and REITs did much better than the overall U.S. equity market, returning over 15%. Fiscal year to date was minus 302, but that gets positive over the next few months. And the 3 year numbers are very strong, 24, 29, and the long-term periods are well ahead of the benchmark. Unless there are questions, we'll go to the fixed income allocation, which is summarized on page 16, and nearly 2/3 of the allocation is in the investment grade 4+5 program. The overall fixed income allocation is 32% of the fund. Fixed income here, as we have in the other funds, is underweight the treasury sector and overweight the credit. Overweight the mortgage sector. Credit is slightly underweight and virtually flat. The managers were either 1 or 2 basis points, or 1 to 4 basis points ahead or behind, but all of the sectors outperformed above zero at least, and were positive returns. And putting it all together on page 18, you see the sector return 129, 4 basis points behind, and the program actually had less than 3% volatility for the 3 year number, which is 847 ahead of the benchmark. And over 10 years, we've returned 639, 25 basis points ahead. PIMCO is the tips manager, sole tips manager here on page 19, so the numbers here reflect their returns. And for the quarter, the returns were 293, slightly ahead of the benchmark. Same thing with fiscal year to date. The 1 year number and the 3 year number are very healthy, returning 1334 and over 10% respectively. And since inception, the returns are 677, slightly ahead of the benchmark. There's one manager here for high yield, that's Sykes, on page 20, and the return was 524, 81 basis points behind the benchmark, and fiscal year to date slightly negative, nearly 200 basis points behind. The results on an absolute basis for 3 years is very strong, but still behind the benchmark. And the returns are, the scale here obviously doesn't quite show it, but the returns are high yield for the 5 to 10-year numbers are in the 6 to 7% range. Unless there are any questions, those are the returns. I do want to give one last piece of information, if I didn't mention before,
Absolutely.
one last piece of information. I think I started with it. The market value was reduced by about $48.5 million for payment of benefits for December 15th. That's it.
Okay. So we need a motion to adjourn the firefighter variable supplement meeting, and we'll start the fire officers variable supplement meeting.
Motion to adjourn the firefighters variable supplement meeting.
Is there a second? Any objections? Hearing none, the motion carries. How about roll call, trustees, please?
Roll call of trustees, Mr. Valentino De Formi.
Present.
Mr. Larry Schloss.
Here.
Mr. James McGowan.
Here.
Mr. John Dunn.
Present.
Travis Farmer can start the meeting. We can start the fire officers supplement meeting.
So we'll go through the quarterly report. Do you need any extra copies?
we have it.
No. Page 3 shows the returns and the market value. The fund was worth $269 million as of December 31st. As you know, the fire officers' one-year liability payment is due on January, so it's not included in here. I do have the number, which was about $21.5 million, and that was paid on January 31st, but it's not included in here. For the one quarter number, the return was very strong at 8.17 on an absolute and relative basis, ahead of the benchmark by 29 basis points. Fiscal year date was negative, similar to what we just talked about with firefighters and with the overall fire pension fund. That number is now a positive number, but it is behind the benchmark. And the one-year number is actually a positive number here, and will become more positive as you see next month's, actually next quarter's results. The three-year number is strong on an absolute and relative basis, returning 13.44. The asset allocation is shown on page 4. About 50% or half the assets are invested in U.S. equity, and the other asset classes are shown here. And it's the major asset classes. There are no private markets because of the need for liquidity in this portfolio. The attribution effect is very similar to what we saw for firefighters, different from fire because the asset allocation was not changed to the extent that fire was. There is no major differences that you see in allocation or management effect, other than for the quarter the manager is slightly underperformed, and for the year, for the 1 year the manager is slightly underperformed, the quarter they outperformed, and for the 3 year they outperformed. And that's summarized on page 8. For the equity side, the summary is on page 10. But if you turn to page 11, that's the U.S. equity, which is 51% of the whole fund, or $138 million. That's entirely passively managed in the Russell 3000 index fund. About 2 years ago, it was changed from the S&P 500. So the historical numbers include the S&P 500 numbers linked to the most recent Russell 3000. It was a strong quarter on an absolute basis, 5 basis points behind, and the results are what you expect from a passive portfolio. And I will point out what I pointed out to the firefighters. If you look at the 5-year number, the U.S. equity market is 0.0%. So, by the way, that's 7 basis points ahead of the benchmark. The EFA markets are actively managed and were ahead of the benchmark nicely for the quarter, but behind for the fiscal year date. And 1 year number, quarter was 628, ahead by nearly 300 basis points, and for the year was behind, although that has improved significantly in January, February, and March to date. The 3 year number, though, is very strong at 1060, almost 300 basis points ahead. Emerging markets is about 3%, or $9 million, and your manager outperformed and returned 569. And has outperformed for the fiscal year date of 1 year number, which is good because the number is negative. That number will turn positive or less negative as we see next quarters go on. The 3 year and 5 year numbers for 3 years are very strong, 1917, but behind the benchmark by over 100 basis points. The 5 year number is much more modest and also behind the benchmark for that time period. REITs Morgan Stanley is the sole manager here, and just like the firefighters, the numbers are very similar. Very strong numbers, reached it at a very good quarter, and Morgan Stanley kept up and added 22 basis points on top of that. The fiscal year-to-date number is behind the benchmark and is slightly negative at minus 322, but the one-year number is positive and behind the benchmark. The longer-term numbers, in fact, the three-year number is 24%, and that's over 200 basis points ahead. And since inception, the program has returned over 5%, 184 basis points ahead, and you'll note that, as we mentioned before, the market has continued to go up in January and February, so if the quarter ended here and we saw the March quarter, you can see stronger numbers long term. For fixed income, that's nearly 30% of the assets here. The policy is 70-30, $79 million, and two-thirds of the assets are in the investment grade program. Page 17 shows the breakdown of the three sectors here. 20% of the assets are in this, that's $54 million, and we will underweight the government sector and overweight mortgages and slightly underweight credit. The manager for the government sector was under by 1 basis point, mortgages under by 13, and credit was ahead by 0.5%. The good news is that all three sectors outperformed, and you see that on page 18 with a total return of 141, while it wasn't as high as the equity returns, and is a positive return ahead of the benchmark. Fiscal year to date and the one-year number are stronger on an absolute basis, but behind the benchmark. But the rest of the numbers, longer term, are all ahead of the benchmark, and the three-year number is very strong at 925. The 5 to 10-year numbers are in the 6 to 7% range ahead of the benchmark, with 3 to 4% volatility. TIPS, again, is PIMCO, and the results here reflect their portfolio. And the results were 293, 24 basis points ahead. And fiscal year to date, which is 6 months, and the one-year number are strong on an absolute basis. One-year number is slightly behind the benchmark, but fiscal year to date is slightly ahead of the benchmark. Then we have high yield, which was very hot during the quarter after a cold quarter in September. That's why you see the fiscal year-to-date number. Actually, it doesn't have a number there, but that number, it's a flat line. It's minus 10 basis points. That's the second column to the left. For the quarter, though, it was 526. Your manager here is Sykes, and 79 basis points behind. And they trail for the fiscal year and 1 year, 3-year numbers, although the 3-year number on an absolute basis is quite strong. Going out longer term, it's a 6 to 7% return, with about two-thirds to half of the volatility of the overall equity markets. That's all I have for now.
Any questions for Mark? Perfect.
Is that it?
Yep.
So we need a motion to adjourn the fire officer's variable supplement fund and resume the fire department pension meeting.
So moved.
Okay, objections? Here are no objections, so motion carries. We now need a motion to move into executive session.
Motion to move into executive session.
Okay, we've got one.
Second. Any objections? Hearing none, the motion carries. Do we have to do a roll call? Or
Roll call remains the
same. Okay.